Welcome to episode 10 of the Property Prescription with Tony and Phil. Today we've got a great question from our online Facebook community that I think you started.
Yeah, so I had some questions about property investing a few years ago, and I didn't really know where to post, so I started a group called Property Investing for Doctors. And now we've got over 5,000 members.
5,300 now, it's been growing.
So it's all screened. We'll try our best to screen to make sure it's just doctors coming in. So if you want to join and you're a doctor, go on Facebook, find Property Investment for Doctors, put your APRA number in, and we'll check it. And if you've got any questions... So we're lucky enough to have a lot of doctors who are interested in property investing, but also people like yourself who's actually got some real experience to answer some questions, such as the one we're going to talk about right now.
Yeah, so I'll hand it over to you, Mike, and you can ask the question because we see these sorts of case studies all the time.
Thanks, guys. All right, I'll read it out. Any issues with a block of units/rental that is different to other residential properties? Is this the right time/age to pivot to income earning strategies? Details: inner eastern Melbourne, apartment style, 6 units, land size 760 square metres, but heritage, so can't KDRB anyway. Close to public transport, mix of 1 and 2 bedroom units, rental yield estimated 140k per year gross, aiming to spend 3.5 to 3.75 million. We have a few investment properties, but single titles with mixture of single dwelling, apartments and townhouses across New South Wales and Victoria currently. Situation: 2 professionals, late 30s, early 40s, 2 young kids of primary school age looking at public school or private secondary if need be. Total current debt, total across PPOR and investment properties 2.7 million, but a few of them with rental yield helping pay the debt. Value of portfolio, 5.5 million. 1 million in offset, but we'll use some for deposit and stamp duty. Income is 550k gross with scope to go to 750 if I go full time. 600k in super, 200k in shares. We've previously aimed at high capital growth properties, but this opportunity came up and the thought of paying this off and having passive income sooner, in the next 10 years maybe, to retire early is tempting. Over to you.
Great question. And we see these sorts of case studies with our doctors all the time on Property for Doctors. This is a very typical sort of $10 million case study. Look, I love the fact that they're well and truly ahead in terms of their portfolio. A lot of our doctors, once they hit 40, they only start to just get going. It seems like these particular clients have really made a fantastic start. Now, when we look at unit blocks, and we're actually buying a lot of unit blocks in Melbourne as a business, a lot of our doctors are consolidating 2 or 3 of their Melbourne houses, and we're buying a block of units for between 2 and 5 mil. The issue that we've got with blocks of units is that the land tax implication is still quite high. You still get stung on the land tax. But the rental income, and we're of the view looking at our data that rents will rise in Melbourne by at least 40 to 50% over the next 5 years, given the shortage of accommodation. I think they're fantastic investments because the yield will increase over time. So the great thing is the kids aren't in private school because that usually is a massive cash burn, and that can equate to be $80,000 a year between 2 kids. So if they can utilise that saving and utilise those funds to fund a $10 million portfolio, they are the perfect type of client that will build a 10 mil portfolio before they retire. Now, for us to build that client and build that portfolio, they need to be on an income of at least $500,000. Their contribution that they need to run a $10 million portfolio is $60,000 a year before tax. Anywhere between 60 and 80, depending on what sort of assets. Now, they've focused on capital growth, which is great. And in the first 10 years of your 20-year strategy, you really want to have a focus on growth-focused assets. And then when we've seen the doctor, we've advised them, reviewed their portfolio, they have no debt on their principal place of residence, that's when we start to take an allocation into income-producing property. Now, what I'd be doing is I'd be looking at the other assets they've got in their portfolio, and I'd be saying, where do they sit? Why are we holding these particular sorts of properties? And are we going to be holding those particular properties long term, or do we sell some of them down and maybe look at another commercial asset? So the yield on the block is okay. You look in the inner east of Melbourne, a lot of the blocks are between 3 and 6 mil. It's a lot of money, but I would challenge them and say the return that they're going to get on a direct commercial property will be a lot higher. I would actually advise them not to buy this block and look at a direct industrial property or a shed or a commercial property where the tenant, will pay the land tax, not them, as the owner. So we know rents are going to rise in Melbourne, so it's actually a good play for them, but I would look at every single asset they've got in their portfolio and then give them the advice based on what I think they should or shouldn't be doing. But they're a typical $10 million client, and the end income that they want to be on at retirement will be anywhere between $450 and $500 a year. That is the end goal. So if they came on as a client of ours, that would be the 20-year sort of goal that we would build out to.
I do have a question about that. I also looked at some blocks of flats that were selling in Geelong. They were much more affordable. I think there was one selling for less than 2 million and 6 flats.
Yeah.
My concern is, I probably shouldn't be getting into property investing if I was concerned about this. I don't want to deal with 6 tenants. Like, what are your thoughts about, like, is this the time? Is it going to be a major time sink?
Yeah.
Like, the effort to deal with all the problems that's going to come with each property?
It's a great question, because from our end, we've always gone for suburbs that are blue chip, that we know the quality of the tenant profile has the ability to pay for the rent. Okay. The problem about buying a block of units with more than 4, you have to go and get a commercial loan. So that means you actually pay the commercial interest rate rather than the residential interest rate. And the commercial rates at the moment are 5 to 6%. So this person buying this block of units in Melbourne is trying to buy it for residential. It's a bit of a hybrid where it's a bit of growth and income. And from my end, I would say, well, why don't you, if you've got $3 to $5 million, you're better off buying a commercial investment on a 5, 6, 7% yield where you're only dealing with one tenant, but you've got to make sure that's a good quality tenant. And we're buying radiology centres, we're buying healthcare assets all across Australia where we know the tenant, we know they're going to sign a long-term lease because of all the capex and all the investment, to set up a radiology, look at the costs so we know those tenants aren't going anywhere. So we know they're going to stay in that particular building for 10, 15 years. So to your point around tenant profile, yes, it's risky if you're buying the wrong block in the wrong area. And I see it time and time again where the unit block's only 60% rented because they've had issues with their tenants. But all the Sydney blocks that we purchased back in 2008, 9, 10, brilliant, because people were happy to stay in those units and they were happy to pay. And the rental increases that we had in those A-grade locations occurred at a far aggressive rate than, say, a Geelong. You can buy a Geelong block for 1 to 2 million. You get 6 to 8 units, but are you going to get the same rental growth as Melbourne? Are you going to get the same rental growth as Brisbane and Sydney?
Sure.
So it's the quality of the block and the location, I think, that drives the value.
And I also didn't realise that you said if it's more than a block of 4, it goes
Correct.
into commercial.
Correct.
That's what the bank thinks.
Yeah. So
it doesn't matter how much that actually it costs.
Yeah. So we're just about to secure a block of 6 units in Elwood for another Medico, and that was about 3.8. But they have to go and get a commercial loan.
Okay. Well, that alone is
wipes it out in terms of
you lose your yield.
Correct.
Straight away. Okay.
Absolutely. And this is what people, so the little 2, 3, 4 packs, if you want to buy some villa units, on one title and you can strata them, there are opportunities if you're buying that block in a growing market where rents will increase, you take the lower yield with the view of taking the higher uplift. But see, something like this, I would be telling this particular client, it's not a bad investment, but I would challenge them and say, well, why don't you just go and buy a direct commercial property on a higher yield? And what yield did they say? It's generating 140K a year gross.
On 3-4 million.
So the net yield is they're better off maybe buying 2 houses and getting the same outcome.
Yeah.
So it doesn't quite, it's an okay investment that sits in their portfolio, but could they do better? I would challenge them on that. So it's a great question, and we really promote jump on Property Investing for Doctors, ask these tough questions. We see it all the time with our doctors.
Yeah. Let's make sure we link this particular podcast back to the OP so then they get the information, because this has been really insightful for me as well.
Yeah. And there's no right or wrong. Every client is different in terms of their portfolio, but we would have to get an understanding of what they hold. But a doctor on $500,000 to $600,000 is building a $10 to $12 million portfolio. It takes them 17 years to 20 years to pay off all the debt. So we don't want any debt sitting on their investments. And then that generates an annual income of $500,000 to $600,000 a year. Okay. And we model it out. Thanks very much. So jump on propertyfordoctors.com.au or Property Investing for Doctors, our Facebook community that Tony's done a great job on. We'll end it there. Thanks, Tony, for joining, and great episode.
Yeah, thanks. That was fascinating.